2, 1, 0, now. Whoa, 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 whoa. I'm Rodd Duff, your host.
And I'm producer Barbie.
And together,
we bring you our podcast,
Insights and Straight Talk. And with that, producer Barbie and I are out. I love that song. I just love that song. I want to change that opening. It's just getting, I see so many shows every day, you know, at least for me. I know we get a lot of guests on here, or not guests. We get a lot of guests, but we get a lot of people watching the show. So I think I want to do another, as soon as I get some time. I've got a new helper that's helping me with something here. Not very much time, you know, it's a very limited budget here, my God. But anyway, good morning, everyone. And welcome to Insights and Straight Talk. I'm Rodd Duff, your host, here with producer Barbie. And today we go into Wall Street, right? Not the headlines, not the NBC News noise, sorry, the machinery of it. Because here's the question: what actually compounds capital over time? Good question, right? And more importantly of a question, what quietly destroys it? James Barrineau, you know what, James? We went over this, and now I don't even know if I got it right. But anyway, James has spent over 25 years moving through the financial ecosystem, large firms, hedge funds, RIAs, and foundations. He's been in the rooms. He's seen hiring decisions, the incentive structures. You've seen those, the compensation models, the subtle misalignments. That one I want to dig into deep. And here's what fascinates me even more. When someone who has lived inside hedge funds tells you most people shouldn't be investing in hedge funds, it's not clickbait. I can tell you that. That's structural. We're living in an area of fee compression, all right? AI-driven research, talked a lot about that. Consolidation, platform dominance, and advisors trying to figure out where their edge lives. That's a scary thought. Because meanwhile, the great American middle class is just trying to retire, trying to build wealth, maybe even of some sort, you know, trying to avoid catastrophic mistakes like talking. So today we ask this, not talking, we ask this: are we investing intelligently? You know, are we buying narratives? Are incentives aligned? Or are we subsidizing someone else's bonus pool? James brings operator insight, recruiter insight, foundation CO insight, and I want to unpack it all because this show is about building durable systems, and capital managed correctly is one of them. Let's get into it. Let me move this over, and I am going to say hi to my new bestest friend and smartest friend in the world, Mr. James. How are you? Mr. Jim, how are you? Boy, I'll tell you, I'm starting off horrible, aren't I, Jim? Gee, I said James in the opening too. Oh my gosh. Oh my. He is my friend, but I don't know if I'm his friend. So we'll figure that out during the show. Jim, let's talk about it. How did you get going? What was that inflection point? And I really want to dig into this because, as I said, this is a subject. Most people, the elites, have a lot more access because they have more money and there's nothing that, hey, that's it. That's cool. But we don't have that access as readily or even think about it as readily. So today, this is like, woo! All right, let's teach us. Tell us what's up. Tell me the journey though.
Okay. I came to Wall Street in an unusual path, I would say. Usually,
Right.
you go to a great school, you get an MBA, firms fight over you, off you go, you make a lot of money. 30 years later, you own a small island. I went to community college. I joined the Navy, and then
Hey,
I
thank
worked.
you for your service, dude.
Thank you. And
I'd say, oorah. I'm a Marine Corps family, but I know there's a little bit of inner fighting there between the dear friend brothers. Go ahead.
yeah, mutual respect.
Absolutely.
So then I worked for the CIA as an analyst, and this was around the time when the Cold War was ending, and things were changing, and they were looking for economic analysts to kind of shift the role. So I put my hand up. I became an economic analyst, and through a piece of serendipity, I met a guy who actually had an intelligence clearance. He was a reserve officer in the Army, and the CIA, I'm not giving away any secrets here, the CIA, talks to guys on Wall Street to see kind of what's up, or did during my time, in terms of capital flows and stuff like that. So we became kind of acquaintances and friends. He opened the door to my first job on Wall Street, and off I went. So, I didn't have that traditional path. I started at a firm called Smith Barney, which no longer exists. I went to Salomon Brothers, which no longer exists, and then Citigroup,
Right.
through a series of mergers. And I spent about 5 or 6 years at Citigroup. I went from there to AllianceBernstein, big money manager. Most of that time was great for me. That was about 12 years. I went to a small hedge fund for a little over 2 years. And then I went to Schroders Investment Management, a large European firm, which is actually going to disappear because they just got bought by a US firm. So many of the firms I worked for no longer exist. I don't know.
Kind of a volatile industry, huh? Little volatility over time there. But I just wanted to add in before you saw me right in there. I wrote myself a little note from this. I think I'm on the right path. From the CIA, from your education to the CIA as an analyst, to Wall Street as an analyst because of the shift. What an exciting time you have personally. I mean, that's great how that evolved, but what was sitting behind it and all the reasons for it and the evolution of our country in a moment in time after the Cold War and that change of priorities, and you flowing literally in the seams of it, in the heartblood, the analyst heart. You're watching it in real time. That's an amazing time, isn't it?
So I am incredibly grateful for.
Yeah.
And, it was so much luck and good fortune. Most
Born
people
at the right time, part of it.
Yeah, most people who wind up on Wall Street conclude that they're geniuses because they make a lot of money. But I've been extremely fortunate. I did some really cool things in every step of the way.
You did the blue collar version. You did the blue collar version that ended up the cream of the crop. What was that? Rooney, that football player. This is an extreme. Don't take an insult by this. But the football player, it's Rooney, right? The famous. He was for the Notre Dame football team, and you don't know the story? Yeah. He was the total underdog. He went through all the hard ways up, and finally at the last part of the season, he and he's a hero, right? He's a national. It's a true story. Wow, what a fact! And now here's the thing, and I'm sorry, I'm taking too much here. I won't. I promise you, I won't do this the whole show. There'll be parts. I'll be fair. There's over 100 people here, by the way. But all of that is amazing. You're a little bit older than me, I'm gathering. Wouldn't say that by seeing, but it sounds like you've got a little bit more experience in life than I do as far as history. But now we're going into AI, and you're a young, healthy man, and you're going to see, you're going to see that whole shift, and then AI, because you know what it's doing to you're involved in it, right? You know it, right?
Yeah.
You know what it is, right? What it does,
Yeah.
right? And the speed it's moving. Now take everything I just said, coming up to 150 people, and just build off of what I said, if you would, adding to your story.
So I went from being an analyst to a portfolio manager at some point at the hedge fund, and then at Schroders. I built a team. At our peak, we managed $6 billion. So it was a pretty decent product. We went from 25 million to 6 billion in 8 years.
Wow.
So I'm very, very kind of proud of that. And then I kind of aged out a little bit on Wall Street, where they kind of, make you a strategist, a global strategist. It's kind of like you're not in the thick of things anymore. So I left. I've become a consultant to RIAs and family offices. I recruit a bit.
Tell me what an RA is. Tell me, fill out. Go ahead.
Registered investment advisor. So basically a financial advisory firm.
Gotcha.
And that part of the business has really become fascinating. Family offices, and I recruit a bit, and I'm also the chief investment officer for a foundation, which I do on a pro bono basis.
Oh, wow. What does the foundation do, just out of curiosity?
It's called the World Peace Run Foundation. They go around the world and basically run through countries, and in the US, they run through 50 states. They give presentations to schools about, how people have to find peace within. Basically, it's non-denominational, no, really axe to grind. That's just what they do. And
what sucks, Jim? You know what sucks right now is you're talking about a very good thing, and I want to spend a little bit of time on this right now, if you don't mind. But you're talking about a very important thing, that this foundation, and you have to kind of be careful in your words, because you're being filmed, right? And it's just you can't just say what you want to do. Look, hey, we have this foundation. It's non-denominational. We're just here to do that. But it's like, we don't have an axe to grind. We're not against. We're not political. We're not, because everybody's looking for that hurt, I've been affected moment, and that sucks. But that was just a side point. Tell me more about this foundation. Keep going, would you please?
So that's what we do. It's all over the world.
You said through schools, and you talked about religion in schools. So what is that? How does that connect? What does that look like?
It's not really religion. It's more like meditation and, going within yourself.
In the school system? System, or no?
So they will run across these towns and cities across the United States and give presentations to schools. They carry a peace torch, which has been, held by the Pope, Mother Teresa. It's been all over the world. And basically, they just welcome people to stop for a minute in their lives and think about peace and harmony. It's the simplest of messages possible. And the fact that they do it while they're running, literally across the country. I've done a little bit of the run myself, the actual run, and it's unbelievably moving, and it will get you into shape pretty fast. And my very, very, very good friend is the head of the run, and I'm just trying to help establish a financial foundation so they can do it forever.
Wow, hey, that's awesome, man. That's beautiful. We talked about back in the green room. There's so much that is needed today, right? I mean, the great American middle class is on attack. I don't know if that's the right word. That's a little extreme, but from all sides. And and what it all comes back to is working on yourself from the inside out, and things like that do that because they give you that moment where you have to stop. You said it, that moment where you have to stop and just, okay, where am I right now? What is life all about? That's beautiful. So go on with your story. So you do that foundation, and then and now you're coaching people as well on this.
Yeah, so I'm consulting with RIAs and family offices, and also with starting with individuals on portfolio construction. I think eventually I'll be managing money for a very small group of people. I don't want to be a master of the universe. I want to produce good results, and we can talk about this later, but the less money you manage, the higher the probability you'll produce a good result for people, which is completely antithetical to how Wall Street runs. But yeah, so that's kind of where I am at this stage in life.
So one thing we talked about, we've been sending some information back and forth, and you had asked me at one point, and I'm a very strong believer. So here at Insights and Straight Talk, we have an ecosystem. You have an ecosystem, right? So and it's about the message that we're each sending, and this show is we do these shows 6 days a week. One of them is not now, we're on hiatus, but Insights and Straight Talk with Emily and Grandpa Rodd on the Saturday show. And then we have the Mangum News. I'm a columnist for that, where we regionally send these same messages out there and to people about this message. And then there's our social medias, X, Instagram, LinkedIn, so forth. We do all those where we're streaming out to you now, and then we'll do clips. But then what you and I were also talking about is Substack. And Substack is really, to me, I didn't know about it, I don't know, 2-3 months ago, but somebody told me about it, and I did some look and and it's a beautiful community to really exchange and explore ideas. And you asked me, do you mind if you mention your Substack on the show? And I said, absolutely. And so please take a minute. What do you talk about on there? Because I went from zero to, it's a pretty darn good place. So what's your Substack address, and then tell me about it.
It's Barrineau, BARRINEAU.substack.com. So I started writing this a couple years ago. I'm doing it regularly now. I was irregular for a little bit there. One of the things I do there that you don't see from most people who talk about the markets and give you stock tips or things, I put the performance of the foundation in there, so you can see exactly how the foundation is doing. And
the one we just talked about.
Yes.
I didn't even make that connect. That was actually a pretty good lean in, wasn't it? I did not plan that. That was by luck. Oh my God. Okay, so the Substack is dedicated to the foundation, which you talk all about. Is that where you're going with this right now?
No, so it's an investment piece, but I put the performance of the fund that I run for the foundation's fund.
Okay.
And I do that because, one of the things about people who write about finances and markets is they never tell you how they're doing. So there's no proof statement there. One of the things I've always liked about Wall Street is you get a report card every day when you manage money. So I put it out there, and you won't see that in almost any financial writers' pieces that you'll see. So, if you can always say he knows what he's talking about, he doesn't know what he's talking about, you can look at the numbers and get a proof statement there. And then I talk about the markets, and I talk about a little bit about behavioral finance.
Hold on. Before we go to the markets, what is this fund? Tell me about this fund. This fund that is funding the foundation is made up of what?
So I'm the chief investment officer. I run the investment, and I have a portfolio framework that invests in.
By the way, there's over 300 people here right now. Just to update you. Go ahead.
I invest in a number of ETFs, very liquid, scalable ETFs. No single security.
ETFs are the ones that pay you as you go along, aren't they?
They're exchange traded funds. So most of the industry was mutual funds until about 5 years ago. Everything began to shift to exchange traded funds. They're cheaper. You can trade them during the day, etc. And what I do is create a global portfolio. It's based on a few very simple portfolio principles. It's doing very, very well. And that's how I invest.
And those principles, what you mean by that is, according to these very good principles, those principles define the stocks that are in that portfolio?
They define the funds that own the stocks that are in the portfolio.
Gotcha. Okay.
So I'm not doing individual stocks. It's not meant to be chasing returns in the market. It's meant to be, it's a foundation, after all. It's meant to be a very sustainable process that gives you the best results in different market environments. So it's a result of, I think, I've thought an awful lot about best investment practices and how to best produce, good returns. Nobody has the magic formula, but we're doing well, and I have a framework and a process that I use to do that. And I'm basically, pretty transparent about that. We talk about what the markets are doing. So it's kind of a number of different, specifically investment related topics.
So does this come out every week, every month, or
every weekend I write it?
Every week, and you've got you told me you have a free subscription on there, right?
Yeah.
So when you say you go through the markets and you break down how the markets are doing and so forth, I'm assuming you're talking about the ones I would think of, the NASDAQ, the three, the S&P and so forth. That's what you're talking about there?
So that's very interesting. That's a good question, because people are far
I should ask that. Okay, go ahead, please.
People are far too U.S. centric. So I was thinking about this morning.
Okay. Go ahead. The average person, everything you read about the markets, you go on social media to talk about the market, you watch it, CNBC, 90% of it is about the US. It's about AI, it's about software stocks, it's about the NASDAQ. So you don't really put your attention to the rest of the globe. So over the past, let's say 10 or 15 years, that was a great place to be. Big tech was ripping in the US. We had the massive wave. The US crushed the rest of the world. We grew to a much bigger market. You could safely ignore the rest of the planet. Starting last year, maybe before last year, international stocks actually began to outperform the US. Emerging markets are killing the US in terms of performance. So for instance, like Southeast Asia or something? Is that what you're talking about now, or not Europe? I don't think Europe is, are they? Or I'm no expert, but I'm just envisioning who's growing a lot right now, and I think it's Southeast Asia.
Okay, so one of the concepts that I adhere to is it is ultimately connected to growth, but in the shorter term, it's connected to financial liquidity in the market. you'll see me
in that market.
in every market. Yeah,
Oh,
you'll see
wow.
me
Okay.
write about that a lot. I have various indicators and things like that. But the point is, now the tide is turning where the U.S. is actually, so, everybody says the U.S. had a great year last year, and it did, but it got killed by international developed stocks, got killed by international emerging market stocks. So things are shifting. You really have to be global in your investment practices, global in the way you think.
And your portfolio for this fund has all of this sprinkled through it, basically, is what you're saying.
It's so I have this process where
we never talk about this. You're right. I mean, I heard a while ago you could invest in, the this money or that money. That there was a trend of that probably 5, 6, 7, 8 years ago or something. But the only thing I ever hear, and I am probably the typical, on the low end, typical American person, just okay, so I do a mutual, or I do this or do that. Now, producer Barbie's taking it another. Hopefully, she's on here. She's on the West Coast time, and she's a late sleeper, so I don't know if she'll make it on, but she'll definitely watch this, because it's the guys. This, by the way, there's almost 500 people on now, 464 people. So this is really important information, and you just kind of blew my mind, expanded my, let's say expanded. Well, you blew my mind, and that expanded my mind to where now so what you're saying is these markets, the actual markets, not the dollar of this or that, it's the emerging market sectors that are beating out the American or the S&P, right? Because that's stock, right? In that,
in the NASDAQ.
In the NASDAQ, yeah. Wow. Go on.
So, so in the foundation, I actually own more international stocks than I do U.S. stocks, because my process is to follow what's performing. And
well, you said the U.S. is kind of losing it on. It had a great year economically and all that, but why do you think the stocks are? I don't even know what the right word. By the way, I love this question. We'll get to it in a second, but I wanted to pop it up there because it's a great question. Well, then who? But anyway, why is that the case now? Just in generalities, I mean, of course, people want to know that. Not that we know that much, but.
So the U.S. got incredibly expensive relative to the rest of the world.
That's what I thought. Okay.
And the U.S. indices now are basically, a lot of people don't realize this, not just the NASDAQ, but the S&P, essentially half of the S&P is tech or tech adjacent stuff. So the U.S. has become, the U.S. indexes have become unbelievably dependent on the performance of tech. Over the last 3 months, if you invested in a value fund, which is a fund that basically buys cheaper stocks, so it doesn't own a lot of mainstream tech, you've killed the S&P index. So international stocks, value stocks, small cap stocks, they've all outperformed the S&P and the NASDAQ over the last 3 months. So one of the things I seek to do is to kind of allocate among the sectors of the market that are doing best. And really, ironically, even though the S&P has been doing well, it's not the place you should have been. Over the last 3 months, you should have been in value stocks, international stocks, emerging market stocks.
Doing better.
Yeah.
Wow. Are we talking big numbers, or are we doing better by 0.1%, or are we doing better by a couple of points?
Okay, so I created
Are they doing better?
I created a chart this morning. Let me see. I'm just going to take a look at it.
Oh, you want to share it? You want to share it?
Yeah. Can we?
Yeah, you can share it.
Okay.
If you look right underneath your screen, I think either you can or. Yeah, just share it.
Yeah. Let me just go ahead and recreate this. I'll take a
So
stab.
while you're doing that, can you answer Branson here? If hedge funds, and I don't know if that's a fair thing to do to you, but if I want to read it out loud, if hedge funds don't make sense for most investors, who should own them?
Okay, I am going to say almost nobody. So
That's what okay, go ahead. Please expand on that.
So, and this is where, it becomes controversial, and I really like to do things differently and think differently than mainstream people. So the reason why almost nobody, including institutions, including pension funds and endowments and state pension funds, that the model is that you'll put 10, 15, 20% of your portfolio into a hedge fund. Why do they do it? They do it because their peers do it, because there's this underlying assumption in so much of the rhetoric around hedge funds that guys at hedge funds are smarter than guys, who invest for ETFs or things like that, because they can go anywhere.
Hedge funds meaning what now? Forgive me that. Remember, I'm the safety net. What define a hedge fund compared to an ETF or?
Okay, that's a great question. So hedge funds can do anything. They're unregulated, and they are only available to quote unquote qualified investors. So I think the minimum is you have to have 250,000 in investable assets or have a net worth of 2 million. There's a hurdle there for you to invest in a hedge fund, and
gotcha.
So that's smart and reasonable. But my point is that the fee structure for a hedge fund has always traditionally been 2 and 20. So 2% of the administrative costs, you pay 2%. That goes to the administrative costs of the hedge fund.
2% of the value of the fund?
2% of, let's say you put in a dollar, 20 cents of that dollar goes to the hedge fund right away for administrative costs.
Gotcha.
The returns that you make on the rest of the money, you're going to pay 20% of those returns to the hedge fund.
Wow.
So the fees have come down, so that's not a standard thing, but some hedge funds that are rolling in money charge even a higher rate. So start with the basic assumption that most investors don't beat the market. If you have a passive fund that just follows the S&P, I think most people understand this. There are reports that come out every year by S&P. They're really great. That shows the percentage of managers who don't beat the market. It's always, over long periods of time, less than 50%. So let's go with that baseline number that less than 50% of managers are going to beat the market. So if you're going to invest in an active manager, you want to pay as little money as possible because you're gambling that you're going to beat the market through this guy. So if you're paying a hedge fund that type of a fee structure, after fees, the probability that you will beat the market goes down much further. So there's a number of reasons why you...
So hold on. Just go back about 40 seconds in time. You talk about 50% of the managers are not going to beat the market.
It's actually more over longer periods, but let's just say less than 50% beat the market. And this is a common,
and why is that acceptable? Why is that acceptable? I mean,
that's a great question. So
they get away with it.
They get away with it because of...
Is it fair?
It's a combination of marketing by Wall Street, which is super smart. I was an active manager, okay? So I understand I used to write stuff for clients and potential clients. I understand, kind of what the game is. And then it's also a function of how the media covers Wall Street. So if a guy who runs a hedge fund has a great year, and it happens, guys have great years, they own concentrated portfolios, or they make a big bet, God bless them, they crush the market. So what happens then? Then everybody wants to get into the fund. Yeah. When the fund goes from, let's say, 50 million to 5 billion, the average investor doesn't understand how unbelievably hard it is to beat the market as your assets grow to that size. It's just, the probability just metronomically declines that you will beat the market as the amount of assets that you manage rises. And I don't think that is well enough appreciated by investors, because they always, chase the hot fund or chase the hot fund manager. And that's not an indictment of the average investor, because pension funds and other large institutional investors do exactly the same thing. You'd like to think that they have a level of sophistication that is far, far greater than your own, the average investor. And in some senses it is, because that's how they follow the market. But at the same time, they're prone to the same biases as everybody else. If somebody kills the market, then maybe this is the guy who's going to consistently beat the market. And it almost never happens. So let me build on Branson's questions here, because you answered it, and these are all the backups, the reasons why. Let's say, if hedge funds don't make sense for most investors, who should own them? And you said basically nobody should, and here's all the reasons why. What is it? Just the media that's keeping that industry alive, so to speak? It's the mythos that there are some super smart guys out there. So let me put two caveats to this. One is Renaissance, this hedge fund out of Long Island, run by Jim Simon. And if you ever get a chance to read, there's a book that's a bio of his that is absolutely spectacular. I think it's called The Man Who Beat the Markets. And he truly did. He has some type of algorithm or investment process that crushed the markets year after year. So I'm not going to say a unicorn, but he's one of a handful of guys. So the fund got too big. They closed it off to outside investors. They now run the private money of the guys who run the fund, but they also have outside managed funds for outside.
Other funds?
Yeah.
Other funds?
And those aren't doing so great. So,
that's interesting.
Yeah, because they've reached a point, I think, where the quantitative arms race to discover anomalies in the market that are exploitable, and they are there, discrepancies between how different markets around the world go, anomalies in options markets. So they exist if you can just, be a rocket scientist and figure them out. Well, it turns out, there used to be 5 rocket scientists. Now there's 5,000 rocket scientists looking for those anomalies, and they go away when everybody looks for them. So, so caveat number one.
Wait. Hold on. I just want to get this clear. You said they go away when somebody wants to look for them, meaning that bulk makes those anomalies kind of disappear, or when people actually go out looking for those anomalies, they find out there's not so many? Or did you mean a combination of that?
It's a combination of that. So imagine if you bought an asset in one global market and another global market sold that asset, but sold it, 25 cents cheaper than the market you bought it in, and you develop some kind of mathematical formula to arbitrage away that very small anomaly between those two markets, and then you leverage that up, borrowed money, and put more money into that small thing, you'd make a ton of money. But if 10 or 15 guys discover that and do it, it goes away because you've arbitraged it away. And that's what I mean. They existed, they probably still exist, but you get 40 people chasing them, and the probability that you're going to find one and exploit it becomes less and less.
You got to be one of those very, very rare few. Let's jump on a couple of these questions because they're really, really interesting to me. I appreciate this, by the way, very much, Jim. This is some thinking that is next level, and I'm fortunate enough to. Somebody told me I'm one of the luckiest guys around because literally for at least an hour every day, 6 days a week, I get to chat with experts in the fields that we're interested in and that expand the mind. And you get to see those experts from different angles. So it just keeps expanding the knowledge base. And I would not, without the show, obviously, I would nowhere near have this kind of course, our audience can watch every show if they want, but I have to watch every show. I'm here. I'm in the show. And I get it more because I get to ask the questions. And then I get all this smart, really, really smart audience that ask questions that I don't even think about asking, which is even more. So thank you very much for the show. I'm really, really enjoying this. And, it's already been 45 minutes.
Can't believe it.
It's just like, damn. Anyway, Jason here has, why do sophisticated investors, and this is what I was asking a little bit earlier, but he broke it down a little simpler, straight on. Why do sophisticated investors still fall for these predictable mistakes?
I love this question because
I do too.
It's so, having spent 25 years in Wall Street, making investment decisions, watching my peers make investment decisions. The first thing is there's a whole field of psychology or whatever called behavioral finance, which basically has discovered.
Really? Whoa! You can't jump past that one. There's a field called behavioral. Does that mean like emotional, like, or they like Apple because they have an Apple? Is that the kind of thing you mean?
Yeah. So if you're seriously interested in analyzing managers or managing money yourself, you really do need to read like a primer.
This comes out of your recruiter side. This comes out of your recruiter experience, right?
So, well, my managing money experience as well. So there are predictable biases that we have as investors. And one is, for example, we hurt more from a loss of $1 than we feel good for the gain of $1. So there's a loss aversion that operates in a lot of investors. There's a bias towards what you already own. So if you already own a fund, you value that fund more highly than you would if you didn't already own it. And that runs across a bunch of different things. So there's all these very human, predictable biases. And
wow, that's a real thing.
It's a super real thing. And people presume that if you manage money for a living, you have dispensed with these biases. That is 100% false. So professional investors often manage by emotion. They often, will buy an asset. Let's say for $1, the asset goes down to 98 cents, and then they tell themselves, "I'm not going to sell this asset until it goes back to what I paid for. And that might never happen. That means your investment thesis has now become hoping and crossing your fingers that it goes up without considering the facts of why it went down, what is the probability that it'll go back up, et cetera, et cetera. You have that bias because you own it. And all sorts of very predictable things like that. So professional investors are loss averse. And on top of all of that, professional investors have to manage against an index. They can't be too far from that index. They have to worry about their bonus at the end of the year, which is predicated upon their performance. So if they're performing well, they're probably going to be more conservative. If they're performing terribly, they might, shoot for the stars, trying to catch up before the end of the year when the bonus number gets decided. So all of these biases are at play, and that's why it's so very, very difficult to perform well in this industry.
It's frustrating because I think deep down, a lot of us, or most of us, or any of us that have any kind of interest in this additional wealth ability for Americans and really the world, this is a real thing, and it's a good thing as long as you know the rules. And yet we just keep doing the same thing. What's Einstein's old statement about insanity? When you do the same thing over and over again and expect a different result.
Yeah.
Well, this is information that really tracks, because we have to think about the markets differently. And what you're talking about here doesn't sound challenging necessarily, difficult so much as just where to start, where to go, Oh, by the way, I do want to say this. Before the show ends, and we're not there, we've got a bunch more questions, but you see on the right side there, I think for you it's called stage chat or something like that. For me, it's called private chat. Do you see that?
Yeah.
Would you put your contact information where you would want people to contact you at? And also, anyway, put in your contact information, whether that be a website, email, combination of things. The more you put on there, the harder it is to copy and paste, just so you know, because I have to copy and paste it into the comments. That way, somebody who watches the show a second after the show ends, or a minute or a year, they say, oh, damn, I wish I would have asked Jim this. And now they can get to you direct instead of leaving comments. And please leave comments don't get me wrong, folks, leave comments on the show, but I don't check that out every day. So I would say, as you got it there. While you're talking about this, I think we already know the answer to this one, Jim. I think we're pretty secure. We know what you're going to say about this one. This came in a little bit ago. I didn't get to it earlier. I wish I would have. But you had talked about, no, nobody really should use. So Dennis is asking, could passive investing outperform? So this is passive investing, outperform most hedge funds long term.
It does. It's a fact. But I will say this, if you say that to somebody, they will respond by saying, well, sometimes hedge funds are not owned for the purpose of outperforming. They're owned for the purpose of diversification and protecting your downside. That's a fair point. My point to people that is not well appreciated is because of the explosion of ETFs, these funds, there's more ETFs than there are stocks in the market. So you can do anything in an ETF. You can short, you can leverage, you can invest in currencies, you can invest in, most of this is speculative stuff. I would say ignore 95% of it, but some of the funds are really great tools. So my point is, you can be your own hedge fund manager at this point in history, because you have access to ETFs that do option strategies. So you can do an option strategy on an index where you'll underperform if the index skyrockets, but you'll outperform if the index goes down or stays stable. You can do option strategies on bonds. You can short the market, although that's generally very, risky, obviously. But you can.
Is that more of a timing thing where you see something down the road that may cause the economy to dip, maybe interest rises, or that there's a tariff thing that pisses people off or whatever? I'm making things up right now, by the way, as you could tell. But right now, shorting the market, you just said it, shorting the market is pretty risky because the market's really doing good in general.
Well,
is that what you mean by that?
The market rises 2 out of 3 days, I think the statistic is, in general. So it's always a low probability thing to short the market. My point is not that you should be forecasting the market.
Hold on. Can I say something somewhat funny and maybe politically dangerous? Do you mean only Nancy Pelosi should short the market?
Nancy seems to have a pretty good portfolio already. So
she kind of knows what's coming up somehow.
Anyway, I can't give her any advice.
Did you hold on? Since you took it reasonably, did you watch the Trump's? I didn't watch it, but I've seen the outtakes. Did you watch Trump's thing last night? He mentioned that in his thing last night.
I heard
that was bold. It's going to be interesting what happens coming up. There's some stuff happening. Anyway, let's go back to the subject of the day. Go on with what you were saying. And so
you can put together these funds if you want to have low correlation to the stock market, but still have some correlation to the stock market, which is presumably one of the reasons why you invest in hedge funds. You can do it yourself because there's a number of instruments available to you in ETFs. Right. You have to educate or have an educated guide. It can be done. You don't have to pay 2 and 20. And that's why I say nobody should own hedge funds. Institutions shouldn't pay 2 and 20, but they do. And that's why we have billionaire hedge fund managers. They don't need to do that if they were to step back and create a strategy that accomplishes the same goal for a fraction of the costs. Anybody can do it.
Well, first of all, hedge funds now are outdated by definition. And the only reason they're around is because people aren't paying enough attention that ETFs basically are the same thing at a tenth the cost or less.
So there are some hedge funds. So if you want like a quantitative hedge fund that has a black box and invests, like a machine, some people do. You can do that. Okay. So maybe there's a use for some of them, but in general, they're not going to outperform the market. They may give you a somewhat diversified results than investing in a passive S&P fund. I get that, but you can achieve that diversified result yourself by intelligently picking an ETF.
Yeah, so here, let's roll right into it. Randall here has got a question, I think, pretty right on here. I really like it anyway. How should advisors rethink portfolio construction? He said 2025, but in 2026. And really, we're getting close enough. Well, it's still a little early, but in the later of 2026, because it's going to be, I think the market's got some, it does this. So, what we do is dramatic as human emotional beings that we are. But, at the end of the day, how should we rethink these things in 26 and beyond? Or I
So,
should say advisors. Advisors.
so
I'm not an advisor.
that's a great question, and I've consulted with RIAs and helped them construct portfolios. The first
Right.
thing you do is lower the fee structure for their investors, because that is money off the top that you're not going to get back. So
Yeah.
all things equal, paying less for a product is better than paying more. That's obvious. Second thing is be more global. Everybody in the US, and you don't see this from overseas investors, they don't have that home bias. Like if you're sitting in,
That's interesting.
if you're sitting in Europe, for example, you probably don't have the same level of home bias as somebody in the US. And again, US people had a great run. It's probably over, maybe for a long, long time. So you have to think more global.
Wait. Had a great run. Just in the market, you mean? In other words, we're too bloated and the other markets, these other markets you defined or discussed, named, are much more agile and are going to beat the hell out of this bloated market for a long, long time.
So just by the numbers.
You don't mean, you mean independent of economies, right?
Yes. Just
Okay,
I'm talking
okay.
about just investment returns. So
Gotcha.
factually, the US crushed the rest of the world in investment returns over the last 10 or
Gotcha.
15 years. Factually, that period may have ended last year. It's continuing on to this year, where the US is being outperformed. So, okay, I have a chart here. Can I share my screen?
Oh, is this the one you were talking about before, right? I was
Yeah.
hoping we get to this. I was going to bring it up again. Yes, please. Go ahead and
Okay,
share it.
so how do I share on this?
You should have a button. I don't know what yours looks like, but you should be able to share. Let me see. If you don't know how to do it,
Oh, I got it. Share screen.
you got it? Yeah. Share
Yeah.
screen. Exactly. Or tab. You should be able to share a screen or a tab. And then what I'll do is I'll do this. And when you share, it'll show up right here. But until you do that, I'm going to do this. I'm going to screw around with the camera angles so we entertain the public out there and they can have their eyeball. Oh, wait, I see something coming in. All right, so I'm going to add this to the stage. And no, I'm going to do it. I think I'm going to do it a different way. Let me think. No, that'll work. That's not very big though, is it? Can you see it well?
I can.
Is that this right here? This is what you're looking for. What are we talking about here, Jim?
So this is a chart of the last 3 months of performance. The S&P, obviously, better. EEM is emerging markets. EMXC is emerging markets minus China. And VEA is a Vanguard fund for the rest of the developed world. So you can see how badly the S&P has done relative to international investing. And it's,
oh yeah,
people don't follow this. It's shocking, right?
Yeah. And we never talk about it. Why don't we talk about it in this stuff? Do you want me to pull this off stage, Jim?
Yeah, you can do that. So they've underperformed by 15%, the developed world. They've underperformed by roughly 20% emerging markets. It's the home bias that people have in the way they think, in the media they consume about the markets, when people try to make themselves smart about the markets. I mean, how much bandwidth do people give to NVIDIA and AI and software stocks crashing because of AI? That's all you read about. And then, very quietly in the background, you're getting crushed if the US is the only market you're investing in.
Yeah, no doubt. Now, I know we already talked, Allie Morris, she's got a couple of questions coming up here, but Allie Morris asked a question that that before we went to that chart also, we were also dipping into this question a little bit, because you had said in how should they restructure, talking about lowering fees, and obviously hedge funds, we talked already about that 2 and 20. And that's ridiculous, especially if you can do it for next to that, basically next to nothing with ETFs, right?
Yeah.
And I think I even asked this. Did you steal my question, Ali? Are hedge funds becoming obsolete in a low fee world? I think you just add a little color in there, but I think we already know this.
Yeah. So the answer is no, because there are some specialized.
There are some special. That's right. I'm sorry. You did say that last time. So please re-say what you said. I'm sorry.
And,
you're right.
like the quants, black box, rocket scientist
right.
kind of thing. That's an option for people. And then there are these pod shops, so-called pod shops, that are multi-strategy funds that hire teams that invest in every strategy you can think of, put them all together, and supposedly, you get a great great investment return with less volatility. But you don't get that great investment return because these funds have grown so large that they're underperforming, and then you're paying ridiculous, exorbitant fees to do that. They should be obsolete in most instances, okay? They won't be because of the way everybody thinks about markets, but they should be.
Yeah, no, and that's been pretty thematic. There's been a pretty consistent theme in what you've been saying here, and I get that. I totally get that. David here, it's an interesting question. I think they do, I would imagine, right? So if you have ultra high net worth, do you think differently than me? The great middle class kind of folk here. Do they think differently about alternatives? And I would think the answer is yes. Can you?
Because they have, first of all, access to advice that the average person doesn't have. Second of all, they've already diversified themselves among wealth. They probably own a business. They probably own real estate. They probably, have a bunch of assets in other things outside of the normal markets that make them a lot of money. So the alternative space is, because they have so much in assets, it might make sense to diversify away from the S&P. So advisors, the mainstream guy who's talking to an ultra high net worth guy will say, yeah, I'm going to pick you a hedge fund, or I'm going to pick you a private equity fund, and you're going to make a lot of money. You're going to be diversified. I'm going to show you how smart I am, and it's going to work out great for you. Unfortunately, as we've discussed, that's probably not going to be the case. But ultra high net worth people, because they have so many other options, they have so many other assets, love the idea of a diversified stream of income that doesn't go up when the S&P goes up or go down when the S&P goes down. And they don't really, I think, take into account the costs of those alternatives. They're busy running businesses and making themselves a ton of money doing what they're doing, and God bless them for that. But they're not busy thinking deeply about the markets, and their advisors, the guys who make a lot of money advising ultra high net worth guys, are going to be mainstream guys who don't want to blow them up, who are going to say, yeah, buy a couple of hedge funds, buy a couple of private equity funds. I'm going to show you what are the good ones. I'm going to skim a little bit off the top. You're going to be in great shape. So they do think differently, but I think the principle that I'm trying to get across here, that you can do alternative investing without paying a ton of money, applies to investors no matter how much money they have.
So on the flip side of that, you were talking about the everyday guy, the advisors that's working with these ultra high net worth. What's the smartest move for those advisors right now? I
Get
love this
get
question.
global. So, like I
Right.
said in my foundation, the U.S. stock market is the stock market I own the least of. That's You're going to find that to be very unusual and unheard of for the average financial advisor. They just have to start thinking differently about the markets. And one of the things I think about in terms of investing is I try not to make forecasts. I try to observe what's going on in the market and then react to what I observe in the markets. I think making forecasts, which is what Wall Street runs on and financial media runs on, everybody loves to hear what Goldman Sachs forecasts for the US market in 2026, right? So no human can forecast the future. Forecasts are useless, I believe. In fact, forecasts have negative value because they will anchor you around a number. So if Goldman says the market is going to make 15% in 2026, they have no idea what they're talking about, but set that aside. You read that forecast and you say to yourself, oh, well, the market's going to do well. Maybe they're off by 3 or 5%, but these guys do this for a living. That's great. I'm going to put my money in the S&P. But if you observe the markets, what we've been talking about is how poorly the S&P is doing, even though on an absolute basis it's doing well relative to other alternatives you have to invest, other liquid, scalable, deep alternatives you have to invest.
Well, let's take a little bit of a lens turn here for just a second. Kenneth's got a pretty cool question here, and we haven't talked much about AI at all. Although it is definitely we could have another show. We've still got a number of questions here, and let me come back to him. This is correct. I copied and pasted that correctly. Did I not?
Okay. Yep.
It is a valuable skill that I have. And so did I also succeed on this one?
Yes, you did.
All right, folks, we still got some time obviously going here, but just wanted to make sure that somewhere towards the bottom here, because I skipped a number of questions, but somewhere towards the bottom of here, you can get a hold of this valuable information. And hey, there was a ladies' book that you were going to recommend that you had nothing connected to with, but you said it was a really good book. You want to slip that in here right now?
Sure.
Because I know you did that other person's book that was really good, but go ahead. Sorry.
Yeah. So I have no skin in this game, but I read a wonderful book that came out 6 months or so ago called Bad Company by Megan Greenwell. It looks at 4 different firms that were bought by private equity firms that then the whole game of private equity is to borrow a ton of money, buy a firm, make that firm pay back the debt, strip the firm, run the firm in a very lean way, and hopefully the firm does well and you make a ton of money.
Right.
It doesn't work that way for many, many of these things. Sometimes it does. A lot of times it doesn't. And this book looks at the people who were actually affected by that, who got laid off after giving their lives to firms and even hospitals that were bought by private equity, and just the degradation of the way these firms and things worked once private equity got done managing them. It's a real eye-opener of a book, and we could talk about
private equity. Private equity was a beast, man. It was really exciting. It's like the hedge fund thing. Did get a lot of great press. It was this sexy thing that these Americans, and I assume others, were doing from this elite crowd. Hey, look at these folks, man. It was, and then after about a decade, right? It got to be really exposed how ugly and disgusting, and really it was the breakdown of the middle class, the very beginning of it, even because a lot of those then went overseas from there, didn't they? Am I in right timing or not?
Yeah. So the bottom line of private equity is, even if you don't have a moral issue with how they manage their money, the objective issue is they're not producing great returns anymore. When interest rates were zero and they could borrow a ton of money at nothing and then saddle the companies with very low cost debt and still try to manage the companies, better, your probability of success was pretty good. You could ultimately, take that company public, make a ton of money. Now interest rates are higher. It's far more difficult to take companies
Oh, I
public.
see what you're saying. I totally missed that, didn't I? Go ahead. Yeah, I see what you're saying. Go ahead.
So it's way harder to make money. And
I got
there
you.
have been various studies showing that, their investment returns over the past few years have been less than the S&P. And like every Wall Street product that involves a lot of machinations, the fee structure is very, very expensive. So it's
like
it's a
tax
crazy,
on top of something. So it's a heavier burden to overcome, right?
yeah, it's just one of those parts of the market you're going to hear more bad things about as time goes on, I'm convinced. Private credit, same thing. Some of these private credit funds are starting to blow up. There's a company called Blue Owl that's been in the headlines over the past few days. That whole area of the market is just crazy. So let me get back to the question about our institutional
I was just going to say, we really went on a wide sidetrack, but Kenneth here still has this question here.
We did. I apologize for that. So,
no, that was fun.
So everyone is scrambling to figure out what AI can do for them. And AI is amazing at stuff like compliance. There are a number of regulations that an investment firm has to follow, and to follow those regulations, you have to track what all of the funds that invest under your umbrella are doing. AI can do amazing things there. Legal stuff related to the management of firms, AI is incredible. Coming up with investment ideas, there's apps that do that. AI can be very good at doing that. Modeling companies, AI can do great stuff there. Trust me, Wall Street is all over that type of stuff. But what hasn't been proved, and what I don't think will be proved, is AI ultimately giving you better investment results. Because markets run on emotions. Valuations can be extreme for a long, long time. Everybody knows that who's invested in a hot tech stock. And there's just no way to model that or to put enough information into an AI tool that's going to overcome outcomes that might be irrational for an extended period of time. So there's always going to be a place for human judgment and human ingenuity in this sector of the market. But that's not to say that AI is not going to be a very valuable and time-saving, companion to do investment research. It certainly will be.
You know what? I was talking to somebody yesterday or the day before. I forget what show. That's the only downside of doing 6-ish a week, because I had so many interesting conversations, and I refer back to somebody and it's like, okay, was it this one or that one? But we talked about, he was talking about how AI is, and we all know everything you just said, and even writing code, it's just so much quicker and more efficient at doing that. But it also has what's called hallucinations every now and then, right? I think you know exactly what I'm talking about.
Yeah.
And so there's always got to be human interaction and proofreading and so forth. And he told me, and as it was a pretty extended part of the conversation. And I'm like, okay, so the reason in this case that we were talking about, the example was because of cost savings. You can have all this all this investment stuff, all the in legal as well, but all the we were talking about translation, also translating from one language to another, instruction manuals, this and that, and AI's really blown up that industry. So we're going back and forth, and he was saying that, but human beings need to make sure it's correct, because if there's something wrong in an instruction manual and something blows up, well, something's going to happen. So so I was saying, well, wait a minute, hold on. If that's the case, and you got to have humans constantly recorrecting the AI, are you really saving time? He said, that's an interesting point, whatever it was. And he said, because AI can correct. AI is actually better at correcting AI than writing AI in language translation. It's better at, it's very excellent at correcting AI. So what they do is these firms they have the original transcription, let's say, from the one language to the other and whatever it is. Then they have an AI go through and correct it. And that AI, what it does is it says these 3, 4, 5, 7, whatever areas are either suspect or wrong or whatever. And that's the ones that the human correct. I thought that was fascinating. And you know what I saw your head bob, and he's saying yes, correct?
Yeah. So the jury is really still out on whether it's going to wipe out jobs or not. I think it will reduce jobs, but not wipe them out, because people do have to. For example, I did an AI search for the stocks that performed best over the last 3 months. It was completely wrong.
Oh, wow.
And I knew that because I had a easy market source to check it. And
you know what the market was, right?
You just do these various things and realize there's a level of caution you have to exercise, but if you want to have it write a cover letter or something, fantastic. But if you want to invest on behalf of what AI has produced for you, you better be very, very careful.
Yeah, it's the human being. I think to your point on jobs, we spent a lot of time on that same subject as well. And to that point, I think, yes, there may be a reduction, but I think more so there's going to be a change, a reassigning of jobs or reshuffling of job responsibilities that the human, because even my son says, AI is necessary for writing code because it writes it so much faster. So you got to have that, but you don't eliminate the code writers. Code writers have teams of 5, 10, 15 agents that are writing the code, and they're checking and correcting that code as it goes along or redirecting it. So there's going to be there may be a dip in the economy for a little bit because of shuffling of jobs. Who knows? I don't know. I'm not an analyst, but I've talked to people but it's going to be interesting, say 10 years from now, when we're definitely on the other side of that little bit of a shuffle there, which will probably continue on as AI evolves and evolves and evolves and evolves. Actually, but so that's the end of my point. I could keep talking, but actually right now I want to ask you this. At what point, how many years, I ask everybody in this conversation, and it's pretty close. The Jetsons are here. The cartoon, right? I used to say the Jetsons are coming. The Jetsons are coming. Well, they're here. As a matter of fact, Google is really one of the original AI. That's actually an AI. But what do you see where you step back and you go, okay, 3 years, 10 years, 50 years from now, that's the point where everything in the world's going to look different. From right now, just from right now.
Maybe 5 years, but
yeah,
it probably. So has nothing to do with investing, but a little rant about tech is I think that
I'm sorry. We are off, and I am talking about not investing necessarily. I'm talking about tech. Sorry.
So I think tech is a bell curve where the benefits of tech skyrocketed. We got the internet, we got smartphones. It's amazing. Life is fantastic. But then we started to get like smart glasses. Do we really need smart glasses? We got the metaverse. Do we really need the metaverse? Now we have social media algorithms that just make money from making you angry. Do we really need that? So, the world might look differently, but hopefully it will look a little bit tech lighter in many ways than it does today. It's just
interesting. So you're thinking about 5 years from now, we're not only going to have a different looking world. I talk about my kids are the bridge generation. None of the generations before them ever saw anything you or I ever saw. They have no idea what a payphone is. A phone plugged into a wall. What? The world without internet, the world without social media, on and on and on and on and on, right? I mean, think about it. How long was the Industrial Revolution? That unfolded over decades and decades, maybe century, right? Centuries.
Yeah.
Horses, cars, planes, trains, spaceships, blah, blah, blah. This evolution is over minutes. I mean, literally. When I first started asking that question a year and a half ago, because we do a lot of the different lanes, right? When I started asking that a year and a half ago, it was like 50-ish years, maybe 20 within my lifetime or less. 50. Maybe within my lifetime. I'm hoping to be a centurion. The facts are now we're talking, like you said, 3, 5, 10, something maybe less is really where it is right now. And it changes by the minute. Sorry, I just wanted to make a big impact on AI there at the end, because I don't think we have any more questions on AI. But
we do have one more question here.
Oh, we do?
Do you see it?
For AI?
No, not
Oh,
for AI.
no. We have several more questions. Okay. I just mean for AI. I'm sorry. Okay. Jeffrey, how do you identify truly aligned incentives in a firm? Totally different question. But yeah, that makes sense. Because I was wondering, they're totally aligned. What with your own mission, with the mission that you're investing in it for, that when it's unaligned, because there's a lot more fees and stuff that kind of squeeze out of you. And if you don't support that, you don't support that. So I was wanting to ask this question. You notice it's been up for a while.
I love this question because it's what I think about a whole lot in relation to Wall Street, and really everybody should ask this question of themselves. So theoretically, your incentives are aligned because the fund manager that you do, whether it's ETFs or private equity or hedge funds, will make more money if you make more money, right? That's the way it's supposed to work. That is not the way it works, because we've found ways to subtly change those incentives such that it sounds like that's the way it works on the surface, but it doesn't. So let's say you manage an ETF. You're not going to get paid just on making your investors money. You're going to get paid by growing that ETF. So I was a fund manager. I spent a lot of time going out and pitching to people to invest in the fund, because the firm that I work for wants to run very big funds that provide very big fees and make everybody a lot of money. I've said this twice already. I'll say it again. The bigger a fund is, the less probability there is that fund is going to be a good fund for you to invest in. So
that's interesting.
There is a point at which your incentives are aligned. If you just paid that portfolio manager a percentage of the true return he provided to you above the market, above a passive fund, to me, that would be a perfect incentive alignment. Because
Yeah.
if the manager doesn't beat a passive fund, you don't pay it. So he's got to do better. So just take your money out of that fund. If a manager does great, he should make a lot of money. He should make a nice percentage of the money above the S&P because he's given you an extraordinary and unusual return. But if his incentive is to just grow that fund, let's say I start a fund tomorrow. I do great.
Okay.
I base it on my foundation. My foundation's doing great. The fund does great. Okay. All I want is a percentage of the assets over the S&P. Everything's going great. But I think to myself, man, I could be rich if I had 500 million to manage instead of 5 million, let's say. So I go out and I spend 20% of my time talking to investors instead of watching the market. Maybe the fund still does okay, but then I'm successful and I get 500 million and I'm making more money. And I'm thinking to myself, you know what? I could be a $10 million man if I ran $1 billion. So I continue to look for investors. I run $1 billion. Eventually, you hit diminishing returns. And that's where an investor's incentives are not aligned. Ideally, so this is something I want to explore, is if you cap the fund at, say, $50 million, that's not a lot of money in the fund world.
Right.
No more money will you take at that, and then just pay yourself what you produce above the S&P. That's fair. That's fair for investors. It's fair for the fund manager. Investors don't have to worry that the fund does so well that the fund blows up in terms of assets, and then every investor who's been in there since day one has diminishing returns. So $50 million, I think, is a fair level. No fund management company in their right mind would cap a fund at such a small level. They want to be at billions, right? But
hey, let me ask you this. You said that's not a lot of money in the investment world, which makes sense. And so I thought, okay, so you cap it at, what'd you say, 50 million, right? Is that what you said? $50 million. Yeah. So there's funds in there and it's not worth 50 million yet. But let's say people keep reinvesting it in and it's growing. Can it outgrow that 50? What happens?
So you let it grow organically, but not through.
Right. Can't add more in after 50 million.
Right. And then if somebody wants to take out $5 million, then you can find another investor to put 5 million in, but you can't go over the 50 million of original investment that you have in there.
Oh, I like that. That's an awesome plan because it offsets that whole thing. And then they're shifting over to whatever they want that other money. Excuse me. So this is a question I would ask. I told you earlier, I'm that kind of great American middle class guy. Is the traditional 60-40 portfolio? I'm almost afraid to ask this question because of the sophistication that we've kind of driven through. Portfolio is still relevant today.
It is. But it needs to be a global 60-40 portfolio. And a lot of fund managers don't.
Okay, so how does that look? How does that look? So it's got to be a global. Do you say
still 60% equities, still 40% fixed income, but the equities can come international, emerging markets, the US.
What percentage ish? Or does it range?
It should be a range. And most financial advisors offer a 60-40 portfolio for the average client that they have. That's fine. It's not global enough, as we've been discussing.
Right.
So that should shift. My belief is that The 60/40 should be flexible according to market conditions. If you look at market liquidity, not just what you think the market should do,
Right.
that can lead you to conclude in very liquid periods of the market, you should be 80/20 maybe, or 90/10 instead of 60/40. In very illiquid periods of the market where the Fed is raising rates, things are terrible, maybe you should be 40/60 or 30/70. But you can get away with a 60/40 if it's global and the financial advisor really thinks deeply about where those 60 should be and where those 40 should be.
So moving on here, Alan Moore, I told you I think I'm pronouncing that right. She asked several questions here. I think you've got a definite interested investor here. Love the honesty here. And I like this is a different question, right? And we hinted at this. It's more about prestige. Now you said there's certain situations. So let's just separate that. There's the situations where you got to have, that just makes sense. So that's not part of this conversation. But there's still a big number remaining, I believe. That's my theory. That I'm just a dude. More about prestige than performance. Hey, I got
100%.
mine in.
Yeah. So think about the hedge fund managers that get quoted in the press all the time. Bill Ackman, Steve Cohen.
Yep.
You know, there are various other guys out there. Wouldn't it be cool for you if you could tell your neighbors that you were invested in Bill Ackman's hedge fund? That'd be spectacular.
Oh yeah, you talk about the afternoon tea party, man. You're hitting it all, right? Or the golf game, huh?
Yeah, and imagine the guys at the country club who have $5 or $10 million, and the guy brags that he's got a piece of Bill Ackman's hedge fund. It's ridiculous, right? But it's human nature. So
it is. It is.
I'm an amazing skeptic of hedge funds. Like I said, I think you can do it yourself. You don't have to pay that 2 and 20. You're making somebody else rich. 100% guarantee of that. You're going to be rich. Very shaky proposition. So yeah, they're definitely more about prestige.
Yeah, absolutely. I you know, it's good, man. I'm so excited by this conversation. I really appreciate all this because it is a different look than what you would hear from somebody who's got a different reason for saying the message, right? I mean, let's just put it that way, you know. So I like what Randall's saying here, and what I want you to do, if you would, is you know, we're over an hour and a half now. And there's still 500, almost 500 people on. I'm sure they're going to start dropping off here pretty quick. But what I wanted you to do is, as Randall here asked this question, and I think he asked a question earlier too. I love it when audience members get really involved. So do you think RIAs will outperform big firms over the next decade? I think you alluded to this, and now we also lean back into the AI, right? Lean back a little bit into the AI discussion. And then would you, the 500, almost 500 people, a couple of people just got on. How cute. Leave them with a message, and I'll throw you in the green room. Don't touch the peanuts. And then I'll close her down and go from there. Okay.
So if you're talking about investment returns, I'm going to say no. And the reason why I say no is every RIA I've ever looked at generally slightly underperforms the market. So their 60/40 funds slightly underperforms the 60/40 index. They're all equity funds, slightly underperforms the equity market. And there are reasons for that. So one is financial advisors are not, generally speaking, experienced portfolio managers, or they're farming out their portfolio models to a firm, which may not be populated by guys who've spent a career managing money. They may be populated by guys who are CFAs who just want to give you a run-of-the-mill market performance. And that's basically what a financial advisor is incentivized to do. He's not going to blow you up. So when the market regime shifts, like it has for international versus the US, the RIA guy may not catch that shift. He may not think about that shift. So the bottom line is they're likely to underperform the market in terms of investment returns. But I'm not slagging financial advisors, because the other products that they give you, the tax planning, the estate planning, the other financial tools you need in your tool belt, the ability to, look at the market unemotionally and provide you some distance from the market, those are super valuable things. So I'm not saying financial advisors are terrible. I'm just saying that they're not likely to outperform the index because their incentive is not to blow you up, develop a personal relationship with you, provide you with other value-added tools, and give you a great outcome that would be better than if you didn't have anybody running your money. And generally speaking, over the broad sweep of your wealth, they do that, but they don't have to outperform the market to provide that value added.
Very, very, very good answer, my friend. Anything you want to leave with beyond that, as far as a matter of fact, we already know the answer to this, don't we? And some of that communication we had earlier today, I asked you, what did you want to leave your fan club here? My God. What did you want to leave here as a final thought, and then give a big wave, and I'll throw you in the green room and put a nice little bow in this puppy.
Okay. The key thing is be very, very skeptical. Wall Street provides products because Wall Street thinks they're going to make money off those products. Passive investing, it's been an absolute revolution. And just really try to think clearly about the incentives of the people who are trying to sell you something. And if you do that, you'll avoid a lot of bad outcomes.
Great go, brother. I appreciate this. Like I've said multiple times, and I don't usually say multiple times, really appreciate this show. Great job, great outcome. Why don't you give everybody a big wave, and I'll see you on the other side.
Thank you very much.
There we go. Thank you so much again, Jim. That was awesome, and that was exactly the kind of arc we need to be on here in our discussions and in what we talk about. Here we do. I see this right here. This is if you notice, the ones who come on the show regularly, you've noticed that chair is slowly moving forward, and that represents our voices at the table, part of the Regeneration School project for a fifth core subject. But that there's some really important things that are going on here locally, and it's a critical time. I may have to move it back a little bit. I hope I don't, but you'll notice it's recently really moved forward at a pretty good pace. But as far as today, man, I mean, seriously, you know what stood out to me, just about as far as today's discussion, it's the financial industry. It doesn't fail loudly. And I mentioned the arc earlier because I'm kind of on this discussion of how systems break and erode. So it isn't loudly. Oh, wait a minute. Hold on. All right, hold on. I got to go back to this one. So, Jim, you got somebody who wanted to jump in here from Brazil, I believe. This guy is a seasoned vet, moving like Drunken Miller. I don't. Do you know? Thumbs up. Do you know who Drunken Miller is, there, Jim? Thumbs up or thumb down? I can't hear you. Thumbs up or thumbs down? I can't hear you. You know who? Okay, hold on. I'm bringing you back on. Okay, tell. I was getting ready to close the show and they didn't want the show to close. So, hey, it's their time too. I mean, is that fair? Do you mind coming on? I saw you laugh back there in the green room. So why don't you read this and tell me what the hell he's talking about? I have no idea.
I believe he's talking about Stanley Druckenmiller, who's a hedge fund guy. Good guy as hedge fund guys go. Moving into Brazil recently, I don't know what Stanley is doing, but you saw the chart. Emerging markets are killing it.
Yeah, exactly.
A lot of emerging markets like Brazil, like South Korea, Asia, ex-China, are doing amazingly well.
Wait. What do you mean by ex-China? I know China, but you said ex-China.
Taiwan, Indonesia, Thailand, Korea.
Okay. I got you. The guy looks like a hedge fund. Dude looks like a hedge fund manager, doesn't he?
He does. It looks like he's on a private jet. God bless you.
He does. Go ahead with the way. I just wanted to bring you on real quick, and then I'll
very, very briefly, I think what he's referring to is he bought some Brazilian assets and did well. So emerging markets are doing well. That's a great trade.
Oh. So right there, that's just a total. That dude just blew up your whole argument. Positively blew it up. That's there you go. Hey, thanks, Fang. So this is a guy from Southeast, I would assume. So emerging market. No, Brazil, you said.
Yeah.
All right, my friend, I'm letting you off. I'll see you in a second. Okay, give everybody another wave, and I'll let you say something without cutting you off. So do that again. You didn't say anything. You didn't say anything. Okay, thank you.
Thank you very much.
Well, hey, you know what? Now I'm in a rowdy mood since they made me come back. So, Jim, I apologize. I'm in a rowdy mood. I gave you a little bit of fun there, didn't I? So, as we're talking about the financial markets, they don't fail loudly, right? And like I said, in the systems that we're on, we talk about how these things erode quietly, and in this case, they erode through fees. We were just talking about. I mean, that whole 220 rule is crazy. Through misaligned incentives, we talked about that really close to the end. That, you know what, and this one drives me crazy. Through complexity disguised as sophistication. What James reminded us of today was simple. Durable capital allocation is not sexy, but you know what? It is discipline. It is patient. It is aligned, and it's incentive aware, and that applies for beyond Wall Street. That's this whole conversation about the emerging markets. You know, it applies to how we build businesses, right? How we build teams, how we build families, and how we build communities. So, if you found this, had value in this conversation, here's what I ask, okay? First, subscribe to this channel at Rodd Duff 1939. Second, watch more than one episode. Understand the ecosystem, because we don't talk about headlines here. No, we talk about infrastructure. And then third, share this episode with someone who is managing money. As an advisor, as a business owner, a foundation board member, because the great middle class doesn't need louder voices. It needs clearer thinking. Wait a minute. Clearer thinking. Let's stay on that theme for a while. That's what we're building here at Insights and Straight Talk. And we'll see you next time. I am Rodd Duff, your host, alongside producer Barbie. And as I always like to say at the end of the show, I am out of here.
Before you leave, if you'd like to watch another one of the podcasts, click the first link in the description. We love having you here and we appreciate all your support.
And with that, producer Barbie and I are out. Think about investing.